Paul, welcome.
Thank you, Azzy.
It's
Thanks for having
taken
me.
finally about 2 years for me to get you here and to get you on this podcast. You are, I make no bones about it. You are definitely one of my favorite people to have on the podcast
Thank you.
this year because lots of people want to know about tax, right? So
Yes.
me and you go back 10 years now. And I was just saying off air that I don't recommend people who I've never used before because I think that's disingenuous. We're not just telling people to go and use this company just because maybe you get a sponsorship from them or anything like that. This is nothing to do with that. I always recommend people who I actually use personally, but also then over time I've recommended to others as well. So you, my friend, are one of those people.
Thank you. Yeah.
And thankfully to you, you have been an amazing input to our business to grow from the tens to the hundreds. So today, I'm honestly very grateful that you've come, and hopefully we'll have you on the 19th of November.
Yes.
So today is really going to be talking about tax, landlord tax, title split, and how we do this kind of group company structure stuff, and basically pick your brain on a number of those aspects. And I'm grateful for your inputs.
Great.
So
Great to be here.
yeah, thank you, thank you. So, without further ado, let's get going because we've been told 30 seconds, 60 seconds, 90 seconds is probably the right amount. So, for those investing in properties, how important is it to get your tax structure right before you start buying your first deal?
Oh, it's crucial because failing to get it right means that it's difficult to unwind something you've already done.
Okay.
So often you might, when you're meeting someone the first time who says, okay, I've already bought X, Y, or Z, it's too late. It's
Yes.
very difficult. And particularly with property,
Yeah.
because of the upfront tax costs, stamp duty, land tax in particular,
Yeah.
for us to unwind that structure would involve potentially a second round of costs.
Okay.
So they've got to have that conversation initially. And it can be a quick conversation,
Yeah.
but initial conversation before you start anything.
Yeah, and I think so. So the obvious question is: so what is the right structure nowadays to buy properties in, if there is one?
If there is one, yeah,
Yes.
it's all horses for courses. But I think for people who come to you
Yeah.
or are looking to grow and have a sizable portfolio,
Yeah.
I think it has to be a corporate structure.
Yes.
It's got to be the right structure for them.
Yes.
For those who are perhaps buying one or two passive investments on the side,
Yeah.
you'll hear the phrase almost like, oh, it's my retirement fund,
Yes.
something like that,
Yes.
as well as my pension.
Yes.
Personal ownership probably is still right for them.
Yes.
But for those who want scale,
Yeah.
it has to be a corporate structure.
Yeah. And just to add to that, is it because then if you've got one or two for your retirement, you're not having to do the whole limited company filing, the cost of it, and all that stuff?
Exactly. That's so the biggest burden is the cost. Whereas if there's scale, then it makes it worthwhile to have those costs of running a company.
Yes.
But if it's just one or two, you've got your additional self-assessment reporting,
Yeah.
but you don't have to run a company or have those set of accounts. So
Perfect.
one or two personal, any more, and we're looking to grow,
Yeah.
it's got to be corporate.
And I think you said something also really important is to have that conversation initially. And one of the things that we do as part of the mentorship, when my mentees get to this point where they are going to start to buy, we then plug them into you and your structure to then have that initial advisory for them. And I thank you for that because I think that's critical to have that initial conversation for them because everybody's tax affairs are very different.
Absolutely. And what we can establish from those conversations is, okay, what's their plan right now?
Yeah.
But also as difficult conversations as what their plan for 5, 10,
Yes.
15, 20 years. Because you
Yes.
say everyone's situations might be difficult.
Yes.
And it's not a one size fits
Fits
all.
all.
That's what's
Yeah.
crucial.
Yeah, yeah, no, thank you. That makes a lot of sense. Okay, so when it comes to title splitting, what are the most common tax pitfalls that a new investor overlooks? So when we're buying blocks of flats, splitting them apart, what's the kind of common tax issues?
I think the critical one, which people often miss, is having two separate companies that aren't part of a group, which is crucial. Because what we want to do when we're moving properties aside, at that stage of their life cycle of a business,
Yeah.
all taxes are critical.
Yes.
And they're particularly so initially.
Yes.
That you can see it where the funding is tight, everything is put back into the business for it to grow at that
Correct.
stage.
Correct.
So if we can avoid legitimately having additional corporation tax, having additional stamp duty land tax,
Yeah.
we want to ensure that's the case. So having the right corporate structure,
Yeah.
typically being a group structure, is key.
Yeah.
Having separate SPVs, say for a freehold and leasehold, just doesn't make sense commercially
Yeah.
often,
Yeah.
but also just as importantly, tax-wise.
And I think that's a really good point. So some people come to me and say, you know what, I'm thinking about getting to title split. And they ask me, are we going to do an SPV for every building that we buy?
Yes, and we need to find the person down the pub who's telling these people this, because they're causing us all a lot of problems. But
Yes. Why is that a problem?
Because the best way to think about it is if you read about businesses merging,
Yes.
then often what they look to do is assimilate and cut down unnecessary overheads, reduce their overhead costs.
Correct.
If you're creating, let's say, 5 SPVs for every single flat you're acquiring,
Yes.
then you're increasing those costs. And it sounds odd as an accountant to say this.
I was going to say, yeah.
Talking myself out of business.
Yes.
But it's not just not right.
Yes.
Coupled to the fact that the more corporate structures you have, the higher your corporation tax bill will be as a result.
Yes.
So you've got additional costs and additional
Administration.
admin costs,
Yes. Yeah.
as well as additional corporation costs.
Yes.
And for no end.
Yeah.
It's
I
when
don't
you
know
meet
where
people,
the people get
you often
that
meet
idea.
people and you would say, okay, well, I've got 3 companies. Okay, you talk through all the 3 companies. Oh, and I've got this other company that's got 1 property, and I've got another company that's got 2 properties. Okay, why?
Yeah. Yeah.
There's no.
Don't know.
All those 3 companies do property investment, as does that,
Yeah.
as does that. Well, merge them.
Yeah.
Just simply merge them.
So the advice is basically have a very simple, streamlined structure rather than have multiple SPVs for doing the same things.
Doing this exactly. If you're moving away into, I don't know, development,
Yes.
then you might have a separate SPV for that structure.
Yes.
If you're looking to, I don't know, source outside finance, so maybe a JV partner,
Yes.
again, you might want to have a separate company.
Yes.
But you've got to think long and hard, and it's got to stack up before you
Yes.
have a separate. Just again, a default. I need a separate company for each property.
Yeah.
Would never.
And I
make
think
sense.
this is where people like yourself as a tax advisor can help people just frame what they've heard in the pub
Yeah,
to what
yes.
actually they should be doing.
Absolutely, because you end up with these sort of legacy portfolios spread across many companies, which we can tidy up.
Yes.
But it's again, it's just an additional cost unnecessarily so.
Unnecessary loss.
Yeah.
Now, you talk about legacy. Again, me and you come together almost over a decade ago to talk about legacy properties and how we were going to be moving personal properties owning personal names
Yes.
into a limited company. If I have to say, the number one question I get,
Yes.
and I'm sure
Yes, it's the same.
the business for you is that, what is the process that you would now recommend people? And I think this is the bit that everybody will want to listen to is how do you move from personal name to a limited company for these existing properties without triggering capital gains and stamp duty? How would you say that?
Fine. Okay. And you're right. That is the key question that we're often asked.
Yes.
So we've got to start going back to basics. And the back to basics is, okay, there are reliefs from both. So there's relief from capital gains tax and relief from stamp duty land tax. And it's really about sitting down, explaining those reliefs,
Yeah.
and getting the person themselves to work through and say, actually, okay, on the basis of what I do with my operation,
Yeah.
how I manage my portfolio,
Yeah.
will it satisfy the reliefs?
Yes.
Now, historically, we were able to, and we would have done in your case,
Yeah.
we were able to approach Revenue Customs and say, do you agree in advance?
Yes.
Do you agree
Yeah.
that we're entitled to these reliefs?
Yes.
Unfortunately, that's been removed.
Yes.
Not because the reliefs are unavailable, simply because of a resource issue.
Yes.
So now it's a case of, okay, working through and saying, okay, we know what case law tells us. We know, based on our discussions with Revenue Customs in the past, when we're able to, what constitutes the threshold for this relief as far as possible. Do you meet that threshold? And it's starting from that.
Yes.
And again, it comes down to that, I think the distinction between a true property business venture activity compared to a passive investor.
Yes.
And having done so, it then asking the question is, what are you looking to achieve from the incorporation? Incorporation on its own, i.e. moving from personal to limited company, is great for some people.
Yeah.
But what are they looking to do then?
Yes.
And again, it's not a one size fits all.
Yes.
It could be, well, I'm looking to achieve this. Well, have you considered an alternative?
Yes.
For most, it is the right answer.
Yeah.
But not for all.
So now unpacking a little bit, because this is so important for us to explain to people how that works. So going backwards a little bit on, so what Is there so there's passive investment and active investment,
Yes,
right? So
yeah.
I mean, HMRC is looking at whether you are the person with the two houses, but you're a doctor and you're making some money on the side.
Absolutely, yeah.
That is probably not right for them to try to move to a limited company
Correct.
structure from a personal name. But if, like myself and other people, we are now spending 60 hours a week managing tenants, managing properties, and adding properties to the business as we go along. But the existing ones, then we want to migrate from the existing personal name to a limited company. We can show that this is a business. We're getting up and doing things into it.
Absolutely.
Is that the almost a very simple distinction that of the two?
Clearly, yeah. What are we doing? What are we doing on a daily, weekly, monthly, quarterly basis with our portfolio? Coupled together with what have we done in the past?
Yes.
So, i.e., if I've bought 5 flats and they're just sat there, okay, I'm more likely to the passive side.
Yes.
If I've bought 5 flats and of 3 of them I've extended out the back to extended for another flat or another rooms or so, a change, so therefore I'm not just sat on my asset.
Yes.
It's now generating more income, increasing the asset value.
Yes.
Again, it points to more activity and it becomes a business.
Even though you are the doctor, you're the surveyor, you've still got a full-time job, but you're still adding value to these properties. You can qualify to then move them onto.
You can qualify because what you'll find, I had a number of discussions myself with these people, is that there is no one else doing it.
Yes.
You haven't got an agent in the background.
Yes.
It's you. Yes, you're working evenings. Yes, you're working weekends. Yes, you're doing all these things in your portfolio.
Yeah.
And that's
and that's a sensible way of looking at it, because if you are doing all of the dog work of finding all these people, the plumber, the electrician, the tenants, and everything else, you're running a business on the side of your career. Anyway.
Absolutely. And we're not required to show that it's full time.
Okay.
We're not required to show that it is 60 hours a week.
Yes.
But what we do need to show is that it's enough to satisfy the
Now, I remember there was a case law back in the days of the lady doing the bungalow. Now, remind me of that and what the hours.
Ramsey case.
Ramsey case, that's the one.
So this is probably the leading case in this area. So this was a block of flats, I think considered 6 or 7 units within a single block of flats.
Yeah.
And interestingly, the test was on whether it qualified as a business in its own right for capital gains tax, not for stamp duty land tax, for capital gains tax, albeit the tests are very similar.
Yeah.
And what happened initially in the first tier tribunal, so the first independent tribunal, Revenue Customs were successful and simply said, pretty much, you haven't disclosed yourself as a business on your tax return. You've included within the land and property pages.
Okay, yeah.
And in additionally, you're not really paying national insurance like a business owner would. Essentially, you've not disclosed it as a business. You disclosed it as land and property.
Yes.
So from that, a lot of people thought that decision was incorrect.
Yeah.
But if it was to be correct, nobody would qualify, because everyone would have to put it, because it is income from land and property.
Yes.
Yes, it is a business. But
yes.
Anyway, the upper tribunal, thankfully, overturned that decision.
Okay.
Now, where it comes to the sort of activities and the business and this hours test, is during the course of the tribunal hearing, the judge asked the taxpayer, how much time do you spend? I think they sort of said something like 20, 25 hours a week.
Yes.
Or as on the properties themselves.
Yes.
And that was it. The judge didn't make the decision and said, on the basis of spending 20 hours,
you qualify.
Yeah. They didn't make reference to that.
Okay,
it was included as part of the discussion, but it didn't make reference to that. What Revenue Customs have taken from that is that's then the threshold.
Okay.
As a threshold. So often you get to this ridiculous situation of 19 and a half hours isn't a business, but 20 hours is. So to be on the safe side, it would be wise to keep a record of the time you spend.
And I remember 10 years ago, you telling me this. I had my spreadsheet of every day, every week, the time that was spending, just in case we needed to show proof of time spent.
Absolutely. And where you'll need to find or show that proof is on a future inquiry.
Yes.
So it's not at the time you incorporate or transfer your business.
Yeah.
It's not even the time when you file your tax return.
Yeah.
It's 12 months after you file your tax return, potentially,
They can
if
come
they
back
ask
at
the
you.
question, exactly.
Yeah. I
And
mean,
it's,
we are now 8 years into
yes,
the incorporation. I think hopefully we're all
touch
right.
wood, we're out the side.
We are outside. But just to recap then, so if somebody's now listening to say, hang on a minute, let me just get my head there. So I've got 5 properties in my personal name. I'm a surveyor, GP, builder, whatever. Do I qualify? Do I not? Should I be incorporating? Because technically, a lot of people on social media say, well, if you've got 6 or more, there's a number that they're saying, but actually, that's
It's
not
not
right.
the case. No,
Okay.
because you could have one unit as a HMO
Correct.
within that
Oh my God,
5,
yes.
and
The
therefore
amount of
that's
hours that you're putting in. Yes.
because- So it's more about sitting back and documenting the
Yes.
hours you spend, because quite often you or I can sit here today and say, oh, I think I spend X.
Yeah.
But unless you're documenting it, recording it on a regular basis,
Yes. What is it that you
you're
do? What
picking up
date? How many hours?
everything you're
Yeah.
doing, and
Yeah.
that's where it will show. So that's the key step.
Yeah.
Is documenting everything you do and having that supporting what you decide to do.
So that's great. So thank you for that. I think that's quite clear. So it's about the number of hours, the amount of effort, the amount of value you're adding to this building, potentially gets you to a point where you may, and if you're going to think about growing the business, you put them, you can migrate that 1 or 5 houses into a limited company.
Yes.
Over time, then start to build on that.
And also, it can also, we're seeing a trend now more about people becoming more risk averse.
Yeah.
If I hold it in my personal name, I'm responsible. I have unlimited liability.
Gotcha.
So we're seeing more issues with people coming to us about tenants and concerns.
Yes.
And thinking, actually, yes, I want to grow, but also I want to protect what I have so far.
Yes.
In my personal name, outside of my properties. So by moving it to a limited company, we can give them limited liability.
Yeah. Because obviously the renters reform bills coming through, all that challenges.
All those sort of issues.
Yeah.
Just because it's only when I step back and think, actually, everything I do on a day-to-day basis, everything I own, not just the properties, my main home, pension, whatever other assets I've got, I'm exposed on a day-to-day basis.
Personally, not on limited liability.
No limited liability.
Yeah, actually, that makes sense. Sometimes you forget, if you're not in it, you're not actively thinking about this.
Yes.
But if there was a fire or something like that,
All those things,
something happens to the tenant, God forbid, you'll be personally liable.
Absolutely. We all have insurance. Everything's in place. But if that doesn't cover us, the buck, unfortunately, would stop with the landlord.
Wow. Okay. So my last bit of that question is, so what is the next step that you would advise somebody? Of course, we will put those show notes, you guys, and the recommendation that I personally, 10 years, 12 years on now, I'm still using you guys, Haslers, yourself as my point of contact. But somebody up in the north or wherever in the country, what would be the advice that you would say? You've listened to this now. There's a potential that you as a landlord with 2 or 3 spending 20, 30 hours a week on this property, you want to move it into a limited company. What would you say that they need to be doing after this?
Okay, I think as a first step, they need to be involving the 3 key parties to the incorporation, that being the tax advisor accountant, there's a solicitor, and their finance broker, lender, bank manager. And it's really key for all those 3 individuals to come together to work through the structure and the steps at each stage. And that's key, because without that, you can end up thinking that some party is agreeing, or thinking somebody's doing something, or perhaps even the lending, which is critical. Is that in place? Who is expecting to lend to who? And how that all fits. So getting all those 3 involved as early as possible is really productive.
It's critical, yes. And I think just casting back how we did it back then, actually, for the listener here, is basically we had to do these. So me and you spoke about the strategy. The lawyers got involved, the broker got involved, who then worked with the lenders, who then said, actually, we've in that one scenario, I think we had to move 10 properties into a limited company. And what happened? We went to one lender who said, we will take all of those 10 under one umbrella, and we'll move everything to us. And there's some timeline, there's some kind of crystallization that you have to pay the other. So there's technicalities. So ultimately, you're right in the sense that they need to have those almost 3 core elements of their strategy: lawyer, broker, tax advisor, who then basically also will work with the lenders. Otherwise, you can get unstuck.
And you can work through timescales then, so everybody knows where. So, okay, I might think I can do it within 2 months. The lender will say, actually, no, we need valuations, we need discussions. It's going to take a further month, and at least then we can manage the client's expectations.
Perfect. I think that's honestly that was the question that I think was the most important to ask today. And thank you so much for giving me lots of kind of responses that I think people will want to hear and hopefully take action to.
Thank
So,
you.
okay, moving on. So, are there any legitimate ways to defer or reduce double taxation within a group company structure when profits are extracted?
When profits are extracted, yes, there would be. So, again, another reason why someone might move across to a limited company or start their property journey in a limited company is the availability of benefits, remuneration planning that is available to all corporate directors.
Yes.
So what we can do then as a corporate director is you can pay, unlike with if you like, an individual property investor, you can do things like, okay, my company can make pension contributions on my behalf, so I can contribute to my pension fund, which I can't do as an individual investor. My company can acquire an environmentally friendly car for me, an electric car, say.
Yes.
Again, which would work well. My company can pay life insurance for me in a tax efficient manner.
Yes.
So the aim is almost to mirror what you might see with other corporate directors.
Yes.
And utilize tax efficient remuneration structures there.
Yeah. So then you reduce your tax liability by then offsetting some of these costs that you're paying to yourself as a person.
Absolutely. And just as you would with other corporates, the corporates themselves will pay their corporation tax bill. Unlike with a property investor, regardless of your profit, you're paying tax on it.
Yes.
Whereas with a corporate, we can manage that tax much easier.
Much easier.
Much easier.
Perfect. Thank you. So, what are the most common stamp duty mistakes people make when buying, for example, properties or blocks of flats?
Not taking advice. I think it's the most straightforward.
I
don't want to reference any particular former deputy, but it's about not taking advice.
Yes.
And that's of no one's particular fault. Solicitors see it as quite a risky area, so they will say, we're not advising on stamp duty land tax. And it's more about, okay, well, I'm paying the often the default rate.
Yes.
But can I pay the lower rates?
Yes.
And it's just again, having that conversation at the right time to establish, is there a relief here?
Yeah.
How can I qualify for that relief?
Yeah.
And therefore, can my rates be much lower as a result?
Perfect. And I know now MD or multiple dwelling relief has been expunged, so that's not there anymore. But there are other reliefs that people can actually tap into.
Absolutely, particularly if we're buying blocks of flats.
Correct. Exactly. So the non-residential stamp duty rate is a very good one that I teach about, I coach on, and I use myself. And I think that makes a huge difference between paying sometimes £50,000 of stamp duty or £15,000 stamp duty.
Absolutely. And what we're talking about here is it's all legitimate.
Yes.
It's exactly in line with the legislation, in spirit of the legislation. It's just that people are perhaps not as aware of it.
They don't know it,
And thinking back to the last budget where stamp duty rates increased by 5%, or increased to 5%, additional 5% for residentials, that doesn't apply for non-residential.
Correct.
So the gap between residential and non-residential is increasing all the time.
Yeah, absolutely. And people listening to here, so what is a non-residential, for example? If you're buying a block of flats with a shop below and there's a commercial unit to it, that will be classed as a mixed-use commercial, and that also then classed as a non-residential for stamp duty rate. So you end up spending so much less money on stamp duty legitimately. But it's all about knowing the information, and that's where people
we
Paul
come
into it. Paul, what are the top 10 allowable expenses property investors often forget to claim?
Oh, top 10. Well, I think the starting point here is that it's all about keeping accurate records.
Yeah.
And ensuring that you document everything, record everything.
Yeah.
So what I often find is those that don't, it's too late then.
Yes.
They identify their rental income. If it's managed, they might identify their management expenses.
Yeah.
Obviously, mortgage interest.
Yes.
But their travel expenses, their property subscriptions, their stationery costs, IT costs, etc.
Mobile phone,
all these
they
things.
can expense their computer every 2 or 3 years because they're using that.
Absolutely. But those that aren't keeping accurate records, particularly when we bring ourselves down to making tax digital, they're going to fall further and further and further behind.
So what can you spend maybe 30 seconds on this making tax digital? How I mean, I know it's a big subject.
Yes, no.
How does that affect us?
Fine. So for personal landlords,
Yeah.
okay, so not corporates
Yeah.
at this stage.
Yes.
So this could be another reason why someone might think to pass across.
Okay.
So for personal landlords who have rental income over 50,000,
Okay.
they
Gross rental income.
gross rental
Yeah.
income, not profit, gross rental
Yeah.
income of 50,000, they will now need to complete quarterly returns to revenue customs starting from next April. So the first return is due August 26th.
Wow. It's like VAT.
Like VAT, absolutely
Wow.
like that. Yeah, absolutely like VAT, and on a quarterly basis thereafter.
What's the logic behind that?
Revenue customs believe it will reduce errors. Yes, exactly. Now,
Wow.
they had so at the moment we're still in the sort of trial phase.
Yes.
So they're sort of tinkering with what we're expecting. So at the moment we're expecting them to request gross rental income
Mm-hmm.
that you earn in the quarter and gross expenses. Perhaps not even a breakdown of the individual expenses.
Okay.
Yeah,
But it's a slippery slope, right? They start there and
absolutely
then they want everything.
Potentially in the past they talked about payments on account on a
Yes.
quarterly basis. So who
wow.
knows? Who knows? Perhaps it's slightly scaremongering, but when they first announced it, that's what
I had heard that they have to pay in advance of what's to come.
Absolutely. So
But they're not going.
They're
down
not.
that
No.
route.
But
wow.
So we're starting with 50. The following year it goes down to 30.
Yeah.
And the year after that, where we're now 2028, is 20,000.
Wow.
But only applies to individuals.
Owning on the personal name.
On personal. So it doesn't apply to currently partnerships or limited company.
Okay.
All they've said for those is that they're looking at it. At some point, they may bring it in.
But I suppose that would affect all corporations then, because then that becomes a massive issue.
Absolutely.
Yeah. Okay. Capital allowances available on refurb. So one of the big questions that people have say, what can I, when I bought a house and I'm refurbishing it, what is it that's allowable expenses and non-allowable expenses? Sometimes they get confused like-for-like replacement with additional extension.
Yeah.
Can you elaborate on
of course,
in a nutshell, what you how they should see this?
So where you're spending your money on something that's going to give you an enduring benefit, a longer term benefit, then that will often be a capital item, a capital expenditure.
Yes.
So you will get relief on that, but only when you come to sell
it.
the unit in the future.
So this is you buy a house, you build an extension that's £50,000. That is the bit that you're going to be able to claim back when you sell it.
Absolutely.
And you deduct that £50,000 at the end when you sell it.
Absolutely.
If you sell it.
If you sell it, exactly. But a like-for-like replacement, replacing windows, let's say, painting throughout the property, etc., all those type of expenditures, that will be just a repair entitlement, so an annual deduction you'll claim against your rental income in the period.
But let's say we're buying something that's pretty in poor condition. We're now renovating.
Yep.
And we're not adding an extension.
Yes.
So all the renovation work, is that allowable because you are doing the plastering, electrics, plumbing, changing like-for-like windows? Does that mean all of these are allowable expenses against your tax?
It depends how politicians answer it. Depends how run down the property is.
Okay.
So if you're unable to let it,
uninhabitable, yes,
then that will, and you just merely bring it up to a standard of letting, then that will be a capital expenditure.
Okay.
If, however, you could have let it, but you're doing just general works, general repairs, then that would be allowable. So it's a fine line. But again, I would always say, keep accurate records.
Yes.
Discuss that with your advisor.
Yeah.
Let them share everything with them and let them make that decision.
Okay. As we are wrapping this up, Paul, it just goes to show just how important, I mean, you're here. That's how important it is for people who are listening. Tax, you get it wrong, you could really hurt your business massively. But you get it right, like you guys have helped us get our position right, it is so much more fulfilling. So, I mean, the typical thing is, God, it costs a lot of money to get really good advice. Well, yes, it does. But the advice that we pay for has helped us massively over the last decade or so. And, you know, I'm somebody who doesn't like paying for things that don't add value, but clearly, you know, and the right advice adds value.
That's the key. And what I often find is when speaking with people, it's really important to have conversations.
Yes.
We don't charge for every single conversation.
Yeah.
What we want to avoid is that at the year end, someone saying, I did this.
Yes.
I didn't want to call you because I didn't want you, and it's too late then.
Yeah. Yeah.
So always have open and frank conversation, because more often than not, we can spot opportunities. We can then add value.
Yeah.
And then there's an opportunity for everyone to win.
Everyone to win. So in 30 seconds, Paul, tell us a bit about Haslers and what you guys do, and also we will put obviously in the show notes how to get in touch with you guys. But what does Haslers do?
So we are based in Loughton in Essex. We're a all-service firm, so we cover from, as you would expect, sort of accounts, tax compliance, but also then do sort of tax consultancy, payroll, HR, corporate finance, VAT, international tax, etc., etc., etc. So we like to think we're a sort of a one-stop shop.
Yes.
That if I'm unable to help, a colleague will be able to help.
Yeah. And I think I can vouch for that, because we've gone from tax advisory to bookkeeping to advice on different things, and now I know a lot of my mentees use you guys as well, because over time, the business has expanded for them and us as well. So I take the opportunity again, Paul, to thank you first of all for making the journey here, to sharing your information and your expertise on property tax. I have to say, in 10 years, I've stopped looking, but you are the one that I met and found that knew a lot about property tax. Everybody, it's a bit like lawyers. Everybody can say, I can write a lease, until they write a lease and then they go through the whole title split and they get stuck. Same thing with accountants. Everybody can do some bookkeeping, but there are some select few people that I've met that understands property and property taxation and what you can and can't do, like yourself. So thank you so much for taking the time to speak to us, and no doubt we will get this relationship built upon, and lots of mentees and lots of people that come to us will come to you guys as well.